Good morning. Welcome to the Money Matters, the week ending February 27th, 2026. February is behind us. That went fast. The State of the Union was Tuesday, so I thought it might be appropriate to give you a little state of the markets. So we're going to walk through this, and no matter where you align politically, hope you'll watch it. I think it'll be refreshing, at least, or not so much. So I'm going to kind of weave in here some comments and questions and concerns that we get. So one of them is, okay, we've had 3 years in a row of growth. We're at or near all-time highs. Should I continue to invest? Right? Does this make sense? Should we be expecting this big crash? The light blue is the average 1, 3, 5 year return of the S&P going forward since 1950. Okay, so very, very good returns. The dark blue is if you invested in the S&P at the all-time high. So you actually made a little more money on a 1 year, 3 year, 5 year forward return investing at the all-time high. So yes, it's the all-time high. It's higher up the tree, further to fall. But history would suggest that, and it's been proven, highs tend to lead to new highs. Every single time, the S&P eventually reaches a new all-time high. It may not be right away, but just because we're at an all-time high or near an all-time high doesn't mean it's time to run for the hills. Little bit of a change in what's leading markets year to date. This is through the 25th. And this, I think, is important. This isn't really a good or a bad thing. It's just a case for diversification. What you see here is the S&P 500 is up about, we'll call it 1.5 for the year. The S&P 500 minus the 7 biggest stocks is up 3.88%. And the 7 biggest stocks are down collectively 2.51%. So it shows you some of the impact they have on the overall performance of the markets. I mean, they're very, very heavy weighted. And some people would argue it's too weighted in those magnificent 7. But you can still see the diversification works, and it's bucking that trend. Now, this one I really like because it points out what baloney advisors like me tell you. And it's not baloney, but all the games you can play with numbers and averages. So if we were to say, for example, hey, we would long-term S&P is 8 to 10%. And so you would say, oh, well, probably earn 8 to 10% every year. No, you won't. In fact, this is from 5 to 10%, and going back to 1950, so about 75 years of data, it's only done that 6 times. Now, on the left of the chart, those are all the years it did better than that. The majority of the time, quite a bit better. A few times between 0 and 4.5, and then when it did worse. But for the most part, you're either going to make more or less, right? And I don't think anyone's surprised by that when you think about it. But just remember, average is average. There's always going to be better and there's going to be worse. And a lot of times that's going to happen within the year. We're going to talk about that in a minute. Again, politics. I don't get too much into politics because some people may not like this. You can't really control it. And for the most part, it's a non-issue. And what I mean by that is we're always going to recommend investing. We're always going to recommend staying the course within strategy, right? We do have buffers and protections, but look, this is the S&P 500 under Democrats and Republicans. If you didn't have the chart, could you tell which one's which? And I'll save you the guessing because the return long term is almost the same. It's within a percentage point. Okay, so whether your people or person is in or not, it doesn't mean you just run for the hills when they're not. In fact, if you do, if you invested under all presidents, this is $1 invested in 1950, grew to $417. If you only invested in Democratic presidents, you made $46, or you got to 46. If you only invested in Republican presidents, you got to $9. Now, that doesn't necessarily mean Democratic presidents outperformed Republican presidents. There were more of them, but it's just to say, just because maybe it's not your person that's in the office, it doesn't make sense to sit on the sidelines. Another big concern, or I should say question we get lately. Okay, we've had 2 years, now 3 years of really, really good returns. Can can it continue? Well, historically, after that, the average is 9.6%. We just finished 2025 after 2 great years, and S&P was up 16.39. It was only when we had the Great Recession back in the 30s that it had a negative. So again, just because the market's up doesn't mean it's going to turn around tomorrow. And then we get into the odds of making money over time. And this is, this should be shown in every meeting, anytime you're looking at your investments. And it is the difference between time and timing the market. And it's been beaten to death, but it can't. So rolling 5-year period holdings. We're going to skip the first 3 or 4, because if you're investing in the market, you should have a time horizon of well longer than 6 months, and it should be longer than a year. But even at a year, you're going to make money 74% of the time. Going back to 1950, the S&P is up, positive return, 74% of the time. You go 5 years, you're 84%. We have not personally had anyone lose money over a 5-year period. I'm sure it's happened. I've been doing this since 2002, but we haven't had it happen. 10 years, and that's pretty much the gold standard, and 20 years. Now, here's my question, whether you're 30, 40, 50, 60, maybe even 70, if you look at your portfolio and you consider yourself and your heirs, for a lot of people, there is a 20-year, I think the vast majority, there's still a 20-year time horizon. Your time horizon doesn't stop just because you're going to retire. You may want to be a little more conservative, a little less in equities, but if you hold the money, or your family holds the money long term, and that is a trend that has never broken and will never break, because it has to do with overall markets. And if it does break, we've got a lot bigger problems. Now, that being said, again, back to what happens in the short term, an average down year is around 12%. Some are worse, some are better. If you hold 40% bonds, you're not going to see as much in most years. On an up year, 17.7. That's a lot better than 8 to 10. But again, we're talking about averages. The distribution, again, we talked about this. Most of the time, it's going to be very good, over 10%. Very few times it's going to be very bad. This one I like. Look, what if we go to war with Iran? Are we going to war with Iran? I don't know. I hope it's a peaceful resolution. But you can see a number of events here that have happened in the past that at the time were very unique. Not encountered them before. We didn't know what was going to happen. And this is the S&P 1-year return after all those. Average 14.2%. Pretty much everything other than 9/11 and the Ukraine 1 year looking forward was positive. 9/11 did fall into the Great Recession, we called it, or the Great Reset, and that took a few years at least. But all these other major events, they were unheard of at the time, and we tended to move forward. Okay, last piece, and probably one of the key ones. Just because you have a down month or a down quarter, it doesn't mean anything for the year. And I think, again, when people think about, okay, well, average, we're going to have a good year, means we got to start out good, means, to make, 8 to 10%, I should average about 2% a quarter. So let's see if I'm on track. Well, if you look at all these years with this is the average return for that year, or this is the actual return for that year, look at the inter-year low. So 2020, there was COVID. We were down 34% at one point. That was about the end of March. We finished the year up 16% based on the S&P. How about the last few years? Down 10%, down 8%. Last year, end of Q1, we were down about 20%. Remember that? Still finished the year up 16%. So you can't judge the market or the year in a month, in a quarter. You have to look at it from the long term and control what you can control. So what can you control? Investing, staying invested, being disciplined, and not letting the emotions cause you to make rash decisions. So with that, we're here for you, your family, and your friends. Please reach out with any questions. Thanks for watching. Have a great day.